Hi, and thanks for watching. So we received a question this week via email from one of our ACRE readers. This individual wrote, I'm an LP looking for a model to help vet syndication deals. Do you have any models used by LPs in syndication deals to evaluate the deal, as well as the impact of GP fees on return for the GP as well as the LP? And so in preparing a response to this email, I thought I'd put a quick video together showing two such models on our website and how you might use those models to evaluate a deal from the perspective of an LP. Now, first, for those who don't know, what is an LP, right? So here I have just a very basic slide. It was a slide that we use in our accelerator to teach sources of capital as well as partnership level waterfall modeling. And here we have uses of capital, right? So you as a partnership go out and acquire a building, and most of your uses are to acquire that building, and there are some uses or uses of capital to cover fees as part of the acquisition of that building. And you need sources of capital in order to cover those uses. And so you'll likely go and you'll secure a senior mortgage, and then you have some slice that's left over. And you as the acquirer of the property, perhaps, you're the GP, the general partner, you went out, you found the land, you're putting the deal together. You're a small slice of the total sources required to cover this. And so that's this little piece here at the very top. And what you're likely to do, and if you're a syndicator, you're going to go out and assemble a group of investors. If you're more institutional, you're probably just going to one large institutional LP or limited partner, and that individual or individuals will bring the balance of the capital needed to complete the deal, right? And they are the limited partner or the LP. And as an LP, they're going to expect some return. Generally, we call that a preferred return. And then if you can achieve that preferred return for them, they're willing to give you an upside or an outsized share of the upside. So imagine they say, hey, Mr. GP, we want an 8% internal rate of return over the whole period. And anything above that, we're willing to give you a larger share of the deal, even though you're putting in less. So maybe we'll give you 25% of all cash flow above 8%. That's the LP. And so as an LP looks at a deal, they want to understand how much is the GP likely to earn? How much are we as the LP likely to earn on this deal? And how does it compare to all of the other options that we have before us? And so on our website, virtually every model can be used from the perspective of the LP to assess a deal. And I'll show you two such models and how you might use those as an LP to assess a deal. So the first option is to grab a waterfall model. Now, these are not standalone modules. They're simply a module to calculate the partnership level cash flows. And so what you'll need to have done previous to this is calculate the property level cash flows. And once you arrive at a net levered before tax cash flow at the property level, you link that over to the waterfall model. And you see that in this line here. This is our basic equity waterfall model, modeled on annual periods. It's one of the first that we released. It has the option to use both IRR and equity multiple hurdles. It models what's called a European waterfall, where the GP doesn't get into the promote until the LP has received a full return of capital and hit its first preferred return hurdle. But that's neither here nor there. To use this to analyze a deal from the perspective of an LP, you would take those property level cash flows, you'd link those over to your equity waterfall model, which is happening here. You'll then model out the asset management fees and acquisition and disposition fees that the GP will be charging. So in this case, there is a 1% asset management fee that's charged annually. This is a 12-year deal. There's a 1.5% acquisition fee in time zero, and then there is a 1.5% disposition fee at exit in year 12. And then we have some waterfall assumption. So here the sponsor or the GP is putting in 10%, the LP is putting in 90% of the deal. And so if this is a syndication deal and you're 1% of the LP stack, it really doesn't matter because you'll be treated, more than likely you'll be treated the same as all the other LPs. And so you can look at this LP check as your whatever percentage of that. But you enter the equity contributions, you then put in the waterfall assumptions. So what's the preferred return and the distribution percentage to each of the partners at each of the tiers. And then you come down and you can see LP returns, LP 15.93%, the GP in this case taking 47%. What if there weren't any acquisition and disposition fees? How does that change things? Well, now the LP goes to 16% IRR, sponsor to 34%. And so you can manipulate these assumptions, take the baseline that the GP gives you, manipulate the assumptions to see what the impact is of the GP's structure to the deal itself. So that's the first option. You take those cash flows from the GP or you create them yourself in a different model, and then you put it into the partnership level waterfall model. What's the problem with that? Well, more than likely to do this, you're just simply taking the GP's word on the property level cash flows. And that's really where the analysis happens. So the better alternative is to use a full real estate DCF model and model the property level cash flows yourself, starting with the GP's baseline and then adding your assumptions to the deal before even looking at the partnership level cash flows. And one option for that is, for instance, our all-in-one model. So this is a model that I created a few years ago and it's gone through now 40 some odd iterations. And here we can model virtually all property types except for hotel. And you can model hotel, just not to the degree that you might need to. Michael has a great hotel acquisition and a great hotel development model that you can check out. But here we can model out all of our property level assumptions, again, starting with the GP's baseline and then making changes to the GP's assumptions based on our view of the market. And from the LP's perspective, we're going to be more conservative than the GP. And as a result, our assumptions less aggressive. And so once we've modeled our property level cash flows, we'll again come back to the equity waterfall. But in this case, the all-in-one and these full real estate DCF models will have their own partnership level modules. We're going to adjust assumptions. And so in this case, the sponsor fees section is slightly different, but we can say, okay, based on this baseline deal given to us by the GP, we as the LP will earn a 9.4% internal rate of return. The sponsor will earn 26.84. But what if we were to adjust some of these hurdles around? So rather than an 8% preferred return, we ask for a 9. How does that change our returns? Right, it goes from a 940 to a 958 internal rate of return. Perhaps we, let's say, take the acquisition, let's take the disposition fee to 0. Now we do a 972 rather than that 958 or 940, which is our baseline. And so that's how you would use, say, models on our side or other models that you find to analyze a deal from the perspective of an LP. Let me know if you have any questions. Otherwise, thanks for your time.